Hello and welcome to another trades and tutorials video. This is Jeff Fish, president of MarketGauge.com, and in this video I'm going to take a look at a couple of stocks that have specific patterns, or really more specifically criteria, that are ones worth really considering when you've got a situation where you have the SPYs that have rallied up into an area that should be some significant resistance, not to mention the trend line that comes from the highs, and then they start rolling over. So the debate here is, is this just a pullback that if it breaks out, you want to be in early, or is it a pullback that's going to continue lower? And so what kind of stocks do you want to be in from the long side, or focus on from the long side, so that you've got a little bit of protection during some potential periods of volatility? And the other thing that would be nice, and I'll show you how to do it, is to be able to take really low risk entries and put yourself in the position of catching days that, like say maybe the up day we had the other day in the SPYs. And when you don't know if you're going to get a down day, gap down day like this, and this is probably going to be typical of market action up here, you want to make sure you get in on the right day and have low risk. So that's what I'm going to look at quickly in this video. Before I do, if you're just finding us on YouTube, please subscribe. If you're finding us on Facebook, please like us. And know that you can get more videos like this at marketgauge.com/tutorials, and more trading ideas by following us at Twitter at MarketGauge and at MarketMinute. And of course, if you're not already watching this in HD, there is a setting in the lower right-hand corner. Check the HD setting and it'll be a lot clearer. I think you'll like it much better. All right, so as I already said in the intro, the SPYs are kind of rolling over here, but this is the 50-day moving average, this blue line, so that should be some support. But the bigger concern is we've got the Qs, which don't look nearly as good. In fact, they look pretty terrible. And so if the Qs continue lower, this would be indicative of a problem for the whole market. Well, there's actually quite a few, or I'm going to focus on a couple of stocks that have a pattern that during and right after earnings season is one to pay attention to identify stocks that could really have big runs, especially if the market doesn't sell off. So no guarantees that the market isn't going to sell off. That's not the topic of this conversation. If you want that conversation, catch us in Market Outlook, the weekly video that we put out over the weekend. So here's the pattern, or at least one of the patterns, and Amazon exemplifies it perhaps the best. And that is, the stock has good earnings, and it has a good reaction to the earnings. So when that happens, you want to put a range around that day's earnings. And then you want to find low risk entries where you're playing for the breakout of the range of the earnings day, either to the upside, or you could be playing against the downside. It shouldn't break down below that day. Or another pattern that can be established is if you break the low, don't really go very far, and then start coming back up. Right? So it's a really basic setup. But if you focus on that pattern, what do you have? You've got really well-defined risk. You can even take a relatively small risk on a swing trading basis. And if you can then time your way into the stock, or in this case, the stock, on a intraday basis, then you can get your risk even tighter. So how do we do that? Well, we focus on some basic patterns in the opening range. Now, if any of you are familiar with Market Gauge and the opening range, I can't cover the whole thing in this short video. But let's take a look at Amazon yesterday as an example. Now, I've got the SPYs on a 5-minute chart down below, and I've got Amazon on a 5-minute chart here, and I've got the daily chart here for obvious reasons. So the reason I have the SPYs is just to illustrate some of the relative performance of the stock that we're trading. I suppose I could put the Qs in there too. That would probably be better. In fact, why don't I do that for this analysis? So when you look at Amazon, your focus is either going to be through the high or near the low. Yesterday, the whole market started to move higher. So even though the market was rolling over, it was an opportunity to look around and see if there are any stocks that are strong, so that even if the market pulls back as it did today, the stocks that you're playing wouldn't necessarily get as hurt. Doesn't always work that way, but very often it does, and certainly it has today. So when Amazon broke out over the high of that day, that high was 669.98, so 670. So if I draw 670 on this chart for some perspective here, right here, right? So here's a 30-minute opening range high. Here's the high of the prior day. And if you're a buyer over the 30-minute opening range high, you can have a really tight stop down here. And as it turns out, you got the equivalent of your risk by the end of the day. So now if you're a buyer through the opening range, by the end of the day, you're selling to take out some of your profits. And even if it gaps down all the way to your stop, it's a break even on the whole trade. But more importantly, the reason you're watching Amazon is because of this initial pattern. And that's one of the ways in which you can take the opening range, and once you understand how to use this first 30-minute opening range, and use that to get really tight stops on, more importantly, the right daily pattern. All right, so this earnings pattern is one to keep an eye on. Now, if you're not already in Amazon, a pullback down into this level might hold the support, and then you can start looking for opening range patterns in here to, again, take advantage of the same situation. It might even pull all the way back to this low if the market gets weak. And again, if you can find trades that are only a half of an average range as your risk, you can easily get that half of an average range back in the same day that you get in, and then you're into a trade for free. All right, now, Amazon is one example of this, and another really good example of this is Facebook. All right, so why is Facebook a good example of this? Some of you might be looking at, oh, big red candle. Look, not to be dismissed, but the bigger picture here is Facebook has broken out to a new all-time high on good earnings in a market where that is not happening very often. And the following day, it took out that low and then rallied back into the range. So the low of this range is now a great opportunity to identify a good stop. And again, if you were to take a look at the opening range yesterday, you had opportunities to buy against this level, which happens to be the pivot, with a stop under the low of the opening range, which it should not have broken, or even below the low of the whole move. And you again got the equivalent of your risk in the very first day. So not only that, but when the market gapped down today, you're right back to the area where you were a buyer. So in essence, the market had a really good day yesterday and then a really lousy day today. And if you're in the right stocks and you buy them at the right prices, you can sit through the market volatility. And if you're in the right stocks, when the markets go up and have good days, these are the stocks that are going to continue higher. All right, so put those simple two things, but more importantly, that earnings pattern together. Now, this one isn't necessarily the earnings pattern, but everybody's looking at Apple, or at least everybody likes to talk about Apple. And so the question here is, have the earnings just now completely deflated this stock? Well, here's the earnings day, right? So you want to bracket in that day, and that's likely to be some resistance when we get there. Let's call it 96. But if we get back up through there, here's the opportunity. And in fact, there's an opportunity here even below the earnings day, but back into the earnings would be better. The opportunity you can't really see on this chart. The opportunity is on this chart. This is the weekly chart. So big picture here, regardless of what you think of Apple, this is the 200-week moving average. So we're back down to it now. I have to say that normally when you get back to a point for the third time, the risk of going through the point is generally higher. Right? It's not a double bottom here anymore. So there is quite a bit of risk here, but it's very manageable. And so if you haven't looked at Apple on a weekly basis with a 200 weekly moving average, you might want to check this out. All right, so down in here in 09 was the relative level. It hit there again in 13, and now we're here 3 years later. So huge area of support, and if all this does is bounce from the 96 level all the way back up to this high around 111, that's a pretty good move, 10% move. And you've got the opportunity at that point to kind of see how it reacts if it gets back up there. But you may not want to risk all the way down to the lows of this move, 92.40 through 96. Well, you're going to have a couple of points that you can use as reference points. The low of the earnings day, and using your opening range. Now, today, while this isn't the topic of this conversation, we had a different opening range pattern here where Apple actually broke out while the Qs were struggling near the lows of the day. Now, that may not seem all that significant on just any old day, but when you look at Apple's inflection point here around 94, it becomes a little more obvious and compelling as a potential entry to see if you can get in early before it breaks back into that 96 level. Now, that said, I would much prefer be playing with the stocks that are doing well than buying the stocks that are not doing well. But depending on your style, if you can take this first 30 minutes of the day and really understand how to use it and understand the different patterns around it, the important part is you can make really low risk trades in the right areas on the daily charts. So put your daily charts together, use the earnings information, and focus on that opening range, and you can really leverage the ability to get into situations when other traders are stepping back and saying, I don't know, this doesn't look too good. And that's exactly the right time to get into great swing trades. It's also the time, as you can see from these charts, where you can find some pretty explosive day trades. So, hope that helps. If you want to learn more about the opening range, we've got all kinds of information on it, and I don't think any trader should trade without watching what the market does the first 30 minutes of the day and know the patterns that turn into great trades and great reversals. That's all for now. I'll see you in the next video, and best wishes for your trading.